Good evening, everybody, and welcome to our second program in this series of Getting Started. Narrowing the Field is the title of this particular class. It's sponsored by the Mid-Michigan chapter of Better Investing and co-sponsored by Manifest Investing, and I'm joined by my good friend and raconteur, Mr. Mark
Oh,
Robertson.
I'm touched.
I'm giving you the title, Mark, okay? And we're going to talk a little bit about narrowing the field. We spoke at our last class about reading an SSG and the kind of places you look for. Well, now we're going to take you to a place where once you learn how to read an SSG, the next step now is to begin to find some companies where you can begin to create your own SSGs. So you know how to read. Now we're going to try to find some
Yeah, and
candidates
I think
possible.
this I think this is a crucial subject because again, going back to uh, investment club visits. I mean, I walked in on a group of ladies in Naperville, Illinois, and they had threatened me with physical violence. And we oppose violence at investment club meetings. And they threatened me, and I said, "Why are you guys so upset?" Well, said, "We just did 29 SSGs, and not a single one of them are in the buy zone." So this presentation here is intended to help avoid that situation.
Absolutely. The beautiful background on the opening slide here is a picture from Pictured Rocks National Seashore up in the Upper Peninsula, and that's not the ocean. That's the Upper Peninsula of Michigan, and that's Lake Superior. The water tastes different in Lake Superior than it does in the Atlantic or Pacific Ocean,
You're not
folks.
supposed to drink the water.
Uh, no sharks, no sharks, okay? So with that, let's go to our disclaimer real quickly. This is an educational presentation. There's our title slide. This is an educational presentation. We are going to talk about a lot of real stocks in real time. Basically, we're just using them as examples. We're not making any recommendation to buy, sell, and hold. We think that you're smart enough to understand that, and we're trying to teach you how to take control of your own investing decisions. And part of that is making your own decisions on when to buy, sell, and hold. We're glad to help you with information. We're glad to help you put studies together and put screens together, but ultimately the final decision on whether you add it to your portfolio or not belongs to you, not to anybody else. If you'd like to be added to our roundtable list, and the roundtable is the monthly Mid-Michigan program that we've been doing for over 14 years now. We maintain a portfolio in the roundtable, folks, and for those 14 years, our return has beat the market by anywhere from 4.5 to 7 points. At the moment, I think it's beating it by about 4.7%. If you'd like to be added to the guest list from the Mid-Michigan chapter, drop an email to nkavula1@comcast.net, and she'd be glad to lead you through the process of getting your name onto the Mid-Michigan guest list. What that means is we'll send you an email once a month telling you that the roundtable's coming up, telling you the date, and offering you a link where you can register if you wish. If you have questions about today's presentation, that's my email address under Q&A. And if you'd like copies of the slides, that's Mark's email address. He'd be glad to send you copies of the slides from tonight. This entire recommendation, this entire presentation will be up on the YouTube channel, the Manifest Investing Roundtable YouTube channel. And if you're going to that channel for the first time, we would love for you to subscribe to the channel. We recently passed the 1,000 subscribers mark. When Mark and I started this whole concept, we thought we'd be lucky to have 20 followers. So we're over 1,000 now and moving to, in fact, we're past 1,100 now, so we're moving up, and we'd love to have you on that list as well. That's enough advertisement. Let's go to our first slide,
Yeah,
if you will.
they haven't invited us to put our handprints on the Walk of Fame yet.
Not quite, not yet? Okay, it's coming. All
I do want to
right.
encourage the audience, if you see a stock that really needs to be considered by me for tomorrow night, as you may have heard, I'm not sure I've got my homework done yet. And if you got a hot one, let me know in the questions box. Go
Folks,
ahead, sir.
screening for stocks is a basic skill. It's probably as important as doing an analysis of a stock that you've finally chosen. You need something that's going to help you cut down the thousands and thousands and thousands of stocks that exist, to cut it down to a reasonable, manageable list so that you can decide to look at stocks that have a potential of actually being in the buy zone at either now or sometime in the near future. So we're going to talk about many different kinds of screens tonight, and stop us with questions. We have a nice back room there to help answer questions. Stock screeners rely on databases, and the first set of databases that we're going to look at come from Better Investing. The Better Investing screeners use the Morningstar database. So the numbers all come from Morningstar. And it's important for us to understand that Morningstar does not manage or massage the data in any way, shape, or form. It comes to us directly the same way that it's reported to the SEC. Our database includes almost every single stock that's traded on the major stock exchanges, and that would amount to literally thousands of different stocks. We also cover a fair number of Canadian stocks that are traded on the Toronto Exchange. The other database that we're going to look at tonight is the Manifest Investing database, and that includes 16, 17, 1,800 different stocks in the database. And it's a smaller database, but it also includes the most highly traded stocks. And it's an easy database to get a stock added to. You just drop an email to Mark and you say, could you add, and then you name the ticker, and he makes an attempt then to get that stock into the database. His raw data comes from a source called YCharts. And YCharts is a commercial source, just like Morningstar or Value Line or FactSet Research or any of the really numerous different data sources that are out there for stock analysis.
Yeah,
Next slide.
one clarification, Ken. We have about 2,700 stocks that we cover. And I would also urge you, if you send me one of those requests, if you send me a pre-revenue, I'm not kidding, Ken, not even pre-earnings, pre-revenue company, I'm probably going to say, I don't think so, at least not yet. I'll just forward on to Ken and let him decide for me.
Do we all understand what pre-revenue means? It means they don't earn any money. That's kind of a difficult company for us to do an analysis on, and Mark doesn't make any attempt to deal with most of those companies. Although some of the more well-known companies, there is an attempt made to give a set of numbers to it if you need it. We're looking at the Better Investing screener to start with because I just think it's a wonderful screener. And this is what you see on the home page when you log into the Better Investing site. And I put a big arrow there. Do a click if you would, Mark. And you put a big arrow next to that spyglass because that spyglass is where you go to do some stock screening. So click it from the home page once you log on, and you come up with this particular sheet right here. This sheet's kind of divided nice and easily into 3 different pieces, and we're going to focus first of all on the middle piece. So click again if you would, Mark. And the middle piece talks about predefined screens. If you're an SSG Plus user, then you have 6 predefined stock screens where all it takes is a click of one button to actually make the screen work. I particularly like the small company set of companies that comes out, and I like the A-list stocks screen. I like them both. If you're interested in what criteria are being used on these predefined screens, notice that next to each one of the titles, there's a question mark. And if you press that question mark, and let's click again if you would, Mark. If you press that question mark, here I've done it for the small company screen, the bar itself will go green to indicate that's what you're looking at, and the criteria are listed. Now, these are not criteria for the most part that you can control. That's why they're predefined. And we're using actually another better investing product called Stock Prospector to actually do the screening in the database. But it's important for you to understand what kind of criteria are set up no matter what the screen happens to be. So I'm going to take just a moment to go through this criteria and let you know what they're talking about. The first thing that a lot of you don't understand is what is that R2 right after the letters EPS. I think most of you understand EPS as earnings per share, but that R2 is a statistical measure. And I've made a note at the bottom down there to tell you what it is. It basically, in real simple English, tells you how a set of data aligns to a straight line. And if the R2 is close to 0, then the data vacillates all over the place. It's very scattered. And if the data aligns very close to a straight line, then the R2 is very close to 1. So what we're basically saying in English for that first criteria is you want a nice straight earnings line. 0.85 to 1 is data that lines up pretty straight, and we want that kind of a line in a small company. We want the measurements of management, that's pre-tax profit, return on equity, and debt to capital, and we want the first two to be up or even in the last 5-year trend. And we want the third one to have a debt to capital ratio of less than 40. We always give you the benchmark of less than 33, but we've loosened it up just a touch, and we said less than 40 for this particular screen. We define small companies as selling less than $1 billion. And we usually measure our numbers in these screens. And in fact, in the SSG Plus, when we're talking about sales, we measure them in millions of dollars. And that's what that M dollar sign stands for, millions of dollars. So this is sales between 100 million and $1 billion. We start at 100 million, and we're kind of crossing out the micro caps because they probably are in a world of their own, and we'll start at 100 million and move up to $1 billion for small companies then. We want the 5-year growth for sales to be at or better than 12%. That's one of our better investing rules. And then we're saying make the last 4 quarters at that better than 12% as well. In other words, you can get a 5-year trend that's better than 12% with the last year trending down, and we don't want that. We want the last most recent year to at least match the 12 and or do better. The same thing for earnings growth, 12% for the 5-year trend, and the last 4 quarters also at better than 12%. Well, you'd think that there would be 150 different companies that meet this screen, but there's not. Let's go to the next thing. When I do this screen, and I tend to do this screen once every 3 or 4 weeks. Why, somebody says? Well, I find that the screen stays fairly static week to week to week. It's hard to make the screen, and it's hard to fall off the screen. So what I look for every 3 or 4 weeks when I run this screen are companies that I'm no longer familiar with. In other words, newcomers to the list. And when I find a newcomer, that's a very interesting company for me, and I tend to take a real deep look at it. Some of the most intriguing companies that I found in the last 3 or 4 years have come from this screen. I think if you look about halfway down the list, you'll find one of my recent big winners. It's Technoglass Incorporated. And I first discovered this about a year ago on this particular screen. And it's gone from when we first started talking about it to somewhere in the low 40s to somewhere around the high 50s $50 or even $60 a share. And we've been talking about Technoglass now for maybe the last, 6 or 8 months. Very interesting company. Take a look at it if you're interested as well. This screen was done the day before yesterday, and at that time it had 14 entries. And again, I'm going to peek at it about every month looking for new companies. Well, what happens? How do I peek it once I go through the screen, once I want to examine what's on there? Next slide, Mark. Whoops, Mark went to sleep. There he is.
No, I'm here.
Notice you're there. Okay,
I'm
notice the button.
doing my homework on the side.
All right. Notice the button next to Axos Financial, the first one on the list. I've circled it up there. If you press that button and give me a click, Mark, up comes this thumbnail. And this thumbnail is certainly showing me that Axos Financial is an up, straight, and parallel company. Green line sales, blue line earnings per share. Those are price bars, just like you see on an SSG. And there's even a red tick on the last price bar telling you where in the 52-week range, the most recent 52-week range, the stock is trading. The little dots floating off to the right, those are the quarters. So this company is 2 quarters into its next fiscal year. Okay. There's a next button. It's a very standard next button. And when you press the next button, you go to the next company on the list. Pressing the question mark button will give you a short description. Click, and here's the description. It's easy to read. It's usually written in pretty understandable English, so you can get an idea. If you don't know anything about the company, you get an idea about it. And there's also a star up there. I hope most of you see that star. And if you press that star, click again, Mark, then you're going to add your company to a private filtered list. This is a wonderful non-paper pencil way of keeping track of your contenders as you do screening on the tool in the SSG Plus or in the core SSG. This filtered list will only clear itself when you choose to clear it. Give me another click, Mark. Here's where you find the information about the filtered list. Again, there's that opening screen, and they've circled it down there. You can display what's on the list at any time by clicking the top of the 2 bars there. Or if you want to start a brand new list, you can clear the whole list and go back to nothing by clicking the bottom bar. It's a great way to do a half dozen different screens, come up with candidates, and have them all on a single list. What's really nice is once you have that list, you can click on them in any order that you wish, and no matter which one you click on, it'll take you to a blank SSG for that particular stock. Wonderful, wonderful way to keep track of what you're screening for. Let's keep going, Mark. Another click. Here's those A-list stocks that I talked about. I've listed the criteria over there. The A-list stocks talk about using the audit feature. And if you're curious about the audit feature, what exactly is it, then what you need to do is open up any SSG and press the audit tab to take a look at what the criteria are for an audit on an SSG. I think you'll be pleasantly surprised that it's a pretty stringent set of criteria that a stock has to pass in order to completely pass the audit feature. This screen usually yields somewhere between 25 and 50 different stocks. When I did it 2 days ago, it gave me 25 different stocks. These are not all buys. Nothing on any of the screeners in the Better Investing screener speaks to whether or not the stock is a buy or not. That's a decision you have to make. But They will all give you great information. What I start to look for when I run lots of different screens is I start to look for companies where the names keep repeating themselves. So I like to look at what's there. I might go through this list one at a time, the same way that I went through the small company list, and I might add a few of these names to my predefined list, to my list that I'm keeping of possible contenders. Next slide, Mark. If you're curious about audit, again, on the bar, on the tabs at the very top of the SSG Plus, there's a tab that's called Audit. Just click on there and you'll get a really great idea of what the audit consists of. You have to have an SSG open in order for the Audit tab to give you anything. Next slide. You can also do custom searches. There's a number of different things that you can put into the search right here. And let's say I wanted to find a medium-sized company. Well, I might set the sales growth at anything greater than 8% because I know medium-sized companies tend to grow at around 8 to 12%. I might also press the median button, and then I might leave anything else alone. By just doing those two things, I automatically have excluded most of the large companies from the database from this screen, and I've probably excluded a whole bunch of the very small companies from the screen as well. So greater than 8% for the sales and earnings growth, and press the median button, and let's see what happens when you do that screener. I hit the search at the very bottom. It's so easy to use. Press the search and one more button, Mark. And here we are with 420 entries. That seems like a huge list until you remind yourself that you're screening down from over 5,000 companies, okay? So from over 5,000 down to 420 really does take that list down, but it's still probably too long for you to go through one at a time. So you're probably going to want to add more criteria, and you can play around with the criteria until you get a list that's reasonable. Depending on what you're searching from, a reasonable list might be as small as 4 or 5 stocks, or it might go up into the mid-20s or even high 20s. I think once you get a list bigger than that, it becomes a little bit unwieldy to deal with. Next screen. Notice the changes that I made in the screener. I added the buttons for pre-tax profit, and I pressed up and even. And in sector, I changed it from any to consumer defensive. I also made the up and even line go for return on equity. So I've made some relatively minor changes, and I've taken that huge list and I've pared it down now to only 4 contenders. If I'm looking for a consumer defensive stock, here's 4 stocks I certainly might want to consider. I'm not saying they're a buy, but I'm telling you that they meet the criteria, and they're the only 4 stocks that meet the criteria that we've set up in this particular screen. Maybe there's one that you'd like to actually study on this short list. Next slide, please. Here's the third part of the Better Investing Screener. It's called the heat map. Notice it's basically green or basically red, the red going to yellow. When it's really, really green, that's a company that our community in the last 90 days is looking at and getting very favorable SSG results from. When the box gets bigger, that means there's a lot more people studying it. So there's a lot of people looking at InMode, for example, up in the top center. It's a very dark green color, and their SSGs are telling them that the SSG is a very favorable SSG. There's also a lot of people looking at Apple over to the left of InMode over there in the technology sector. It's a pretty vivid red, and it's a pretty big box. So there's a lot more people looking at Apple than InMode, and they're getting unfavorable results as far as a buy or not for that particular company. This might give you some really good ideas. You might pick out the 3 or 4 darkest green ones you can find, and they might be companies that you're really interested in. I'm drawn to InMode and Paycom, Iradimed and PayPal, DAR, which is Darling Company, and maybe a couple others, maybe Perry down there in the bottom. I'm doing some cherry picking, guys, in the back room. Remember that, okay? Next
Yeah,
slide, please.
and I believe InMode got 10% cheaper this morning. So
At least 10% cheaper. I own it.
okay.
I don't talk about that one too much right now, Mark, okay? Uh, let's look at some other stock screens. And I'm going to have Mark walk us through the stock screens for manifest investing right here. You've seen many of us use the manifest investing screener, and let's show how we can create some different screens. Keep in mind the whole time you're listening to Mark and to me that we're using different databases to screen. So we'll get different companies, although there should be a significant overlap when we set up the same general kinds of criteria. Go ahead, Mark, take the helm.
Absolutely. We use very similar sources of data and we use it in very much the same way. We basically are following the same type of philosophy or methodology. So, with the one exception, we are able to use analyst consensus estimates to basically finish out the stock studies. Therefore, we do have the capability of screening on return forecast. And again, looking for what you're wanting to achieve, we're here for the returns. So between us and Value Line, we are able to do that. Answering a question from the questions panel, we do put all the bull sessions links right on the Manifest Investing homepage. And this screenshot was taken yesterday, so it's yesterday's program, but you will find the next sessions right there also. So as you dive into this, you will find a number of, if you click on stock screen, you'll actually be given the opportunity to go to existing or pre-standard screens. I don't use these very often because it's so easy to set the screening criteria based on the toggles and everything else that you can do as you search for the characteristics you want to search for. But you can save your favorite screens here. And Ken, did you want to add something to this?
Well, no, you're doing a fine job, Mark. Keep moving there, okay?
Okay, so uh, clicking on either one of these predefined screens. This happens to be from Ken's arsenal. He apparently likes to search for companies that have decent return forecasts. Well, the quality ranking that we use, that is basically a percentile ranking of the quality characteristics of the companies. So this is the top 20% of all companies. And then he likes to see financial strength that would be equivalent to a B++ at Value Line. And again, up straight and parallel. So he's going to go for very stable and consistent earnings per share. So that is the result. That's one of the ways to look at it. Again, as a reminder, the PAR is equivalent to the output in Section 5 of a stock study. It stands for projected annual return, and it's based on the average PE value for the stock. That's basically the way we look at it.
Yeah, notice how similar the criteria between my standard screen and my very high quality screen are. I've upped the quality on the very high quality from 80 to 85, and I've upped the financial strength and the EPS stability to the 80th percentile from the 70th percentile. You'd be surprised at what a difference it makes in the number of companies on the screening list. We also notice that there's a number up at the top of the criteria called MyPar. MyPar is the same as Value Line making a call on the average return for the next for the stocks in its database, and MyPar gets published every time the stock market trades, and MyPar is the average return for a stock in the manifest database, and it seems to track the value line number very, very closely. So this is a couple days ago, and the MyPar number at that point was 9.2. The market's gone down a little bit, and that would push MyPar up. Think about it. When the market goes down, there's more possibility of return in the stock market, so MyPar moves up. George Nicholson taught us that you want to shoot for 5% above average. So you add 5 to 9.2 and you get 14.2. And he also taught us that it's almost impossible to beat the market by more than 10 points. So we cap the sweet spot at 10 points above the average. And since that average moves monthly and quarterly and yearly, the sweet spot moves along too. On average, over long periods of time, the stock market gives us around 10%. And therefore, for a club, on average, over long periods of time, if you can aim somewhere in the 15% plus range, aha, somebody is saying in the audience, there's that 15% they're always talking about. Well, it's nothing more than the long-term average plus 5. And if you can do that year in, year out, year in, year out, you're in pretty decent shape. Next slide.
All right, so this is the results, I believe, from yesterday or very recently for the very high quality stock screen that Ken often will run. And you'll see that it's a pretty interesting list. Again, you've got a list of companies here that are in the top 10% in most cases when it comes to the quality of companies. And many of these have return forecasts in the sweet spot. So they're in a really interesting place. And again, to my Naperville ladies, this would have been an interesting place to go shopping. And you probably wouldn't have to do 29 stock selection guides to find something. These are more likely to be in the buy zone. Again, trust but verify. Some of these are not going to end up in your buy zone based on the assumptions that you make during your study, but many of them will. Lulu, Yeti, these keep appearing on many of our screens. We recently did a feature on Gentex. Again, many of these companies are pretty reliable when it comes to that. So,
Mark, I feel warm and fuzzy when the par at Manifest comes close to the par that comes off of my stock selection guide. When those two numbers are in the same ballpark, 1 or 2 percentage points apart, I feel validated in the analysis that I'm doing. If I look down at my SSG and it says my average return is 9% and Manifest says the average return is 2%, then I'm a little bit worried about maybe I've been too aggressive, and I go back and I rethink what I'm doing on my stock selection guide then. It
yeah,
doesn't mean I'm wrong. It just gives me pause. That's all.
yeah, and it would be no more different than going back to that slide that I used in the previous presentation. What did you assume for the growth rate, and what are the analysts assuming? What do you use for a PE, and what are they using? And again, what kind of profitability expectations do you have? So it begins again. It's a way of identifying the differences. Analyze the differences. One point that I do want to make, because we're at the end of the first quarter, and many of the year-ending book value and in financial characteristic data points for a number of the banks are finally coming in, I am seeing a fairly widespread drift down in quality. Not big, from B plus plus to B plus when it comes to financial strength. Basically down one notch. A little bit of a reduction in growth expectations. Many of these companies here, I know this one does for sure, fall off this list when they go through their first update for this year. So just be aware of that some of the expectations for the regional banks doesn't mean they're right, but the expectations are drifting downward just a tiny bit. All right. So again, Ken already explained this. We keep track of the average result. It's actually the median for those that are statistically fussy. But it basically tracks around in that 9 to 15% range in general. And as Ken already mentioned, we're basically aiming for a 5% advantage to the market. Again, we believe that our portfolios should be designed and maintained based on this reality. And then at the same time, going much more than 10% over during a stock study. If the return forecast is 25, you had best be dealing with an extremely high quality company or be extremely careful. That's definitely something you want to be careful about. So we'd like them in the sweet spot. We will tiptoe above that 19.2, but only for a fairly consistent, well understood, high quality company.
And I hope you all heard that Mark talked about the portfolio ending up beating the market by 5 to 10 points. That's what we're aiming at. It's a portfolio number. We're not going to make every single stock within the portfolio meet those criteria. We want the weighted average to end up in that sweet spot if we possibly can.
And sometimes that's not really easy. All right, so the predefined stuff are cool. I will confess I don't ever use them because it's just way too easy to go in and click what you want. So here, just like you would find in many other screeners, you can actually limit by sector or industry. I originally didn't want to put this in as a feature, but then we ran into a number of investment clubs that couldn't resist consumer discretionary stocks or something like that. So we would basically make it so that the screening results would completely ignore the stuff they didn't need any more of. So if you have that situation in the club, you can actually click everything but discretionary and keep these guys off the list. Again, it comes down to what your portfolio needs, and you basically click that and basically aim for the quality and return, those two important characteristics. You can see that you can automatically set it to use the sweet spot. Then we'll talk about this in a few minutes. You can actually screen using the triple play, made famous by George Nicholson. So we'll probably do that live. Here it is. This is one of our favorites. We basically make it possible for you to look for companies that have the triple play. And what Nicholson suggested is you look for companies that have been really beat up. Their stock prices have been punished, and therefore they have a high return forecast or an inflated par as the first qualification. Second, you want to look for a situation where the current PE is expected to be possibly several points higher in the future, PE expansion. And then the possibility of an increased profitability from current conditions to the long-term forecast, that is net margin enhancement or expansion. He called it a triple play. He said that you can generally find these type of companies in bear market conditions or after a fairly deep correction. So it is something I have leaned on in the past and actually found companies that helped our portfolios, including our family portfolio, kind of ride out that storm. So we'll take a look at one of those live as we close down here tonight, or perhaps we'll let it go till tomorrow, depending on the amount of time that we have. All right, so Ken, this is a stock screen basically going in and setting those criteria. I assume you were looking for a double-digit return. You can see that here, setting it at 10, clicking the quality in at 80. So again, just looking for highest quality companies, excellent companies, and then financial strength of 80, again, equivalent to an a growth rate of 8. So this is similar to what you did with the better investing screen, looking for companies with a growth rate of 8% and above, and a fairly high earnings per share stability. So we're looking for consistent companies.
And if I
And
had to talk about this in English, Mark, I would say that I'm looking basically for great medium-sized and small-sized companies. I'm not interested in finding any of the really big companies right now, which can be expected to grow under 8%. Now, that doesn't mean that some large companies won't come into this screen. There are a number of large companies that do surpass the 8% growth rate, but the average large company won't be coming through this particular screen. So I'm hoping for medium and small companies out of here, and I got 44 candidates showing you the top 25.
Yeah, and they're ranked by their return forecast. So obviously you would start shopping up at the top. And again, as we go through these screens, I'm kind of doing my homework for tomorrow. Lulu, Yeti, Gentex, just kind of logging them in and retaining them as I go. We have actually talked about Google and Alphabet here recently. This is not quite the return that I want for my homework assignment for tomorrow, but it's still pretty respectable.
Yeah, I'm surprised to see emphasis coming up on so many screens, Mark. I didn't realize that it was so undervalued at the present time.
Yeah, and again, as a teaser for a future bull sessions topic, we're going to take a look at that entire industry, and with some concerns about maybe there might be a little bit of too much overall or global optimism with many of these companies, and maybe that's coming into play here too. The price has dropped, and maybe that reflects some pessimism out in the world of investing when it comes to those companies. So we'll see. All right, what do you got here,
Okay.
Ken?
Well, I felt, Mark, that number of contenders on that last screen was a little bit much. So I kept everything the same, basically, except I moved my par from where it was to 12% now. So I'm asking for a little bit better par, and that cut the screen down now to 17 contenders. It's kind of like looking at the top of the screen from the one I just did, but I can now deal with this list of 17 right here. Again, some very interesting names. I own 3 or 4 stocks on this list. I would think that a good long-term established portfolio probably owns 2 or 3 or 4 stocks from this list,
Hmm.
no matter where that portfolio happens to be. This is a really nice set of companies. And if you're a novice, a beginner, this is a wonderful place to start for studies, screens like this one right here.
Okay, and I'm going to basically draw everybody's attention to Globus. And this is a high number. Be careful out there. Um, what happened here is the transaction that it's actually a merger of equals, and that obviously came into the data. The growth rate of the combination company. You have a company growing at half of the company at 6%, half of the company at 8%. Well, when that gets injected into the long-term forecast, you basically have a visual analysis that's basically going straight up. This number is basically supposed to be about 7. So when we make that adjustment for that large merger and acquisition, these numbers will change. So kind of caught
Yeah,
me on
that
this one, Ken.
we always say that a yellow background means might be too good to be true,
Yeah,
especially when it's more than what's it 15 points almost above the top of the sweet spot.
yep. And it's a good company, but it's a
Yep.
combination of 2 companies, and that is now reflected in the analysis. So now we're going to
So
go high growth. Go ahead, Ken.
I I wanted to add that high growth screen that I just created to my keepers. So all I had to do was title it on the uh, screener itself. I put the Ken's High Growth title on it. And what happens is now when I press stock screen on the opening page, not only do I get the 2 presets that were there, but now I have Ken's High Growth as a preset as well. And that means when I come back to it in 3 or 4 weeks, the criteria will stay the same, but the list will change because the stocks that are being screened have changed up, down in price, up, down in earnings, all kinds of changes have been made. It's a great way to keep a screen that you know you're going to use on a fairly regular basis.
Good stuff. I may have to start doing that. I know the
Okay.
owner. All right, here's
Here's
what. Go ahead.
go on.
I,
No, you
this
go.
this
You
is
go, Mark.
this is one of my absolute favorites. This is the Ivory Soap screen. That's based on the 99.44% purity in the old commercials. And this was really simple, guys. Um, we know that the quality and the par, the return forecast, are among the two most important characteristics. The other one that we would also throw into that is the growth rate. But these two combine to make them what we call the manifest rank. Both characteristic is basically equally weighted. And what I'm asking for, in fact, I enter 99.44. I can't get that in here for
Well,
ivory soap.
I found Mark, and I just should tell everybody, if you try to, you can add 99.44 as much as you want, and then when it prints back at you, it comes up 99. So,
Yeah, it
uh,
truncates.
yeah, it truncates. So I added 99.44 as well.
So,
Okay.
so again, in English, as Ken likes to point out, we're basically saying, show me the top one half of 1% of all stocks, the 2,700 stocks in the database, based on the combination of their quality and their return forecast or par. And this is basically my favorite screen. I would begin shopping um, for, to invest real dollars using this screen.
And I hope, folks, that you understand the difference between the yellow in the last slide, which was 15 points ahead above the top of the sweet spot, and the yellow in this slide. We are looking here at values that are decimal points or maybe 1 point above the top of the sweet spot, and that's doable sometimes. I would not discard these companies with the yellow backgrounds. I would just be a little bit more cautious. You can take a little bit more leeway in the sweet spot when the quality becomes very, very high. And a 90th percentile quality and above is an extremely high quality number.
All right, so a variation on that screen. This is again made famous by Hugh McManus, basically applying a 52-week low criteria to whatever screening that you're doing. Here we're looking for relatively high return forecast, again, excellent quality, double-digit growth, and very stable earnings in combination with being within 20% of its all-time low. This is one of Hugh's mechanisms for basically enhancing his margin of safety. He wants to see them basically down near their 52-week lows, certainly less than 20%, and he takes his vetted list, applies this 52-week low criteria, and he would be giving consideration to some of these that are down in single digits. In other words, very close to their 52-week low. So that can be a very effective way to dive into some screening results also.
I like to think of it as maybe shopping at TJ Maxx, Mark, and looking for and doing a treasure hunt, looking for some really great things. I love to see stocks like United Health on a list like this, because when you look at the visual analysis for United Health, you just want to marvel. It's a classic up straight and parallel, and you say to yourself, this huge company is not going to suddenly change what it's done for 10 years, and here it is, a real bargain today. You know, it's only 2.2% away from its 52-week low. I'm picking up a real bargain here. I should take a look at it, and that's true of many stocks on this particular Irish Spring list. Hugh has played this list like a violin, and he has
An Irish fiddle, Ken, an Irish fiddle.
Irish fiddle, okay, and has really shown us something about looking at stocks that are near their 52-week low, especially when you ask the question, what will they look like in 5 years? Remember, that's one of the questions what Mark said you should be asking yourself as a beginner. What will the company look like? Will it still be around? I can't imagine a world without United Health 5 years from now.
Well, I'm ready for them to stop calling me about their advantage programs, but that's a subject for
It's
another
a
day.
different.
Anyhow, here is a fascinating screen that I have used a number of times for. I'm not a trader, but I am willing to buy and sell stocks, maybe a little bit shorter term opportunities. If you're not familiar with the relative strength index, I would urge you to do some homework on it. You can actually go and read all about it using this link down at the bottom at Stock Charts. This is free, And really, it's just a way of indicating whether a stock is overbought or oversold. If the stock price is really diving, it gets down here into this oversold range. This is what you hear the talking heads referring to when they're talking about oversold and overbought stocks on CNBC. They're looking at some variation of this. And you're not making my homework any easier. These companies keep showing up here, Ken. Um, these RSI numbers will be recent. They're not necessarily today's numbers, but they will be fairly recent. And I have found some golden opportunities during some dark moments in the stock market over the last 10 years when prices are diving and this indicator drops down into oversold can be an excellent way to gauge an entry point. So just something to think about.
I want to go back to that idea of think about the company 5 years in the future, Mark, and I want to contrast these two companies and ask the question: is everybody still going to be wearing track suits and athletic gear 5 years from now? And is everybody still going to be using the largest healthcare provider in the world? Uh, I think the answers might be starkly different as far as what you think is going to be happening into the future. I'm thinking
Well,
back to I'm thinking back to fashion trends, and they don't seem to last for years and years and years. And we've been in this athletic kind of a trend for quite a while now. So maybe things will change in 5 years.
and these guys are firing on all cylinders, so don't take what I'm going to say wrong. But you saw in the previous session what happened to Under Armour when they stumbled.
Yep.
And when companies like this stumble, that's why some of us are reluctant to go into retail for that reason. I mean, that you saw it. Under Armour just fell off the page, and I don't think Lulu is immune from that. It's just something you have to be aware of as you go into it. Stay properly and prudently diversified.
I think a value lesson might be in the early years of my private investment club, the hot stock in our portfolio was Chico's Fashion. And it's not so hot. My wife still shops there, but it's not such a hot stock anymore.
No,
Uh,
absolutely.
times times have changed, fashion has changed, and the stock has changed.
It was a great company. All right. You can also search for companies with a projected yield of greater than 2%. Obviously, shopping amongst the higher quality companies. This is an area where earnings per share stability and financial strength would be important. You might want to ratchet them up, but this is a list of companies if you are in it for the dividend yield.
And
Okay.
again, some community favorites on that list. I noticed Fastenal down there, second from the bottom.
Hmm.
I know an awful lot of our clubs hold Fastenal, so it's maybe you're holding it partly for the dividend. Just make sure that when you're looking at dividend stocks, that it's a dividend that you can see them maintaining into the future. That the dividend yield hasn't shot up because they're in serious trouble. That happens sometimes, and when that happens, the next step might be the dividend yield dropping to zero. And board of directors can do that in one meeting. So keep that in mind.
It's not usually friendly to the stock price when they do. So they
You
don't
got
do
it.
it. They don't do it without thinking about it and sweating over it for quite a while.
Well, here's our core, and I've decided on a different graphic than Mark has been using for core. Uh,
Oh,
so,
you chicken.
so if any of you have come to some of our other presentations, you've seen a much different graphic than the core that I put up there. But core stocks basically are up straight and parallel members of your portfolio. What happens is we look through the literature that Better Investing puts out, and we find out that George Nicholson did not suggest that your entire portfolio had to be up straight and parallel. In fact, he said it could be if that's what you wanted, but you could do as much as 25% of your portfolio in non-core stocks. So I guess you could say not up straight and parallel stocks.
Or
New
future
issue,
up straight and parallel.
maybe ones that are going to in the future be up straight and parallel. Absolutely. We have discovered, and we kind of stumbled our way into the number And we know that it's a squishy number, it's a gray number, but we have discovered that if you take the financial strength value, just the value itself, the numerical value, and add it to the EPS stability value, and add it to the quality value, no percentages, no units, just the number value for those three things, if you add them together, we have discovered that when you're above 240, you're almost always a core stock. And when you're beneath 220, you're almost invariably a non-core stock. And when you're between 220 and 240, then the judging should be done on an individual basis. So we're trying to answer the age-old question. We know that core and non-core is in the eye of the beholder, but we're trying to give you a little bit of a crutch to lean on. Above 240, probably core. Beneath 220, probably non-core. In between, golly, make up your mind or toss a coin, okay? 25% up to that point could conceivably be in a portfolio that was established. Don't try to use these percentages if you're creating a portfolio. Get the portfolio created and then play with it a little bit if that's what you wish to do. Remember, Mr. Nicholson said you don't have to do non-core investing. If you're more comfortable with core investing, I will tell you that all of my personal portfolios are probably closer to 15% non-core than 25% non-core. You can shade the non-core part depending on what your own psyche says that you're comfortable with. Let's do a slide because I was pleasantly surprised when I created the next slide, Mark.
Okay, and one last point on that. If you're relatively new, or if you're an investor who maybe has a little bit of trouble sleeping at night, you don't have to do these. So the suggestion would be if you're again relatively new, if a drop in the stock price is going to make you very uncomfortable, there are no guarantees in this business. But what we have seen historically is that a company that qualifies as core here is going to be less vulnerable to a vicious correction. Doesn't mean it's going to be immune from it, but less vulnerable to it. And that's kind of why we couch this. And for a newcomer or a fairly new novice to investing, again, it's just something for you to think about. So Ken, you actually applied this
Mark,
to a
Mark,
dashboard.
before you go off that slide, I read this presentation 37 times, and there's still a typo in the last sentence.
Yeah,
Before we post it, we can maybe fix that typo. Okay.
I got you covered. I'll cover
All
you.
right. Thank you. Thank you. All right. Well, I applied this idea of non-core core, and in the next slide, I pulled up the portfolio of the. Mark's going to correct it on the fly. There we go. Thank you, Mark.
Only because
Okay.
I can. I didn't want you to go to bed with that out there, Ken.
Thank
There you
you.
go.
We took a look at the dashboard for the model club, the Mid-Michigan Model Club. And lo and behold, I've boxed in the non-core stocks that the club holds, and it amounts to 24.5%. We try to maintain our numbers as close to ideal as we possibly can. Notice that our par is a little bit low right now. We're really scrambling to get back to the sweet spot. When the market's doing really well, it's very difficult to stay above the sweet spot number. So we're scrambling to get there. Quality is very good. Growth is a little bit slow right now. We'd like it to be maybe 12, 12 and a half. The financial strength and the EPS stability are both pretty good numbers. And our core non-core split for this established portfolio is almost straight on to Mr. Nicholson's suggestion. So I was very positive when I read this or when I created the slide. And to be honest, I thought that we were really out of whack with this and that we had too much non-core. Turns out we don't.
That is a cool application, and I would have to say mine is probably more 70-30, and that's because one stock has shot up quite a bit.
This high core value, high quality screen gave us 50 candidates. And I'm showing you the top half of the list. Again, I probably would go shopping down the first 10 or 12. They are particularly interesting to me. And again, some of the same names keep popping up over and over and over, along with some new names. That's the first time, for example, I've seen Genpact up near the top of another list.
Mm-hmm.
Avnet, a very interesting company up near the top of the list. But there's your Lululemon, your Yeti, your United Health, your Gentex, your Infosys. They're all up there near that top again. Those are maybe the kind of stocks that might just tip off a contender study. I'm not saying go out and buy them, folks. I'm saying they're extremely interesting because they've appeared on so many different kinds of screens. And I asked for a minimum core on this screen of 260, not 240, but 260. So I moved to the top of the core number. And again, there's nothing scientific about adding those three numbers. We just found that it worked. That's all.
Yeah, it generally meets the instinct and intuition of most people. Again, the warning: these are probably going down with the first quarter results. Financial strength on those regional banks. I'm not casting doom on them. I'm just telling you they're going to take a modest adjustment to the downside. So I thought we would close with just a couple other summaries. This one's a little bit different. We track about 600 funds in our database. Hopefully, we get our fund coverage back up to snuff here shortly. Just wanted to make the point that only about 20% of funds actually beat the market over the trailing decade, and only 2%, as shown here, achieved that plus 5% investment club objective. So the round table comes in somewhere around here. So that's what the wild lady is for. We've got pretty decent results over the last 14 years at our monthly roundtable webcast. What we actually use this list for, however, is a couple of things. When we're going shopping for ideas, we will let these guys be the screeners. We're basically looking over the shoulders of the A-plus students in the class. We want to watch for what they're adding or removing from their portfolios. We'll actually dive into individual portfolios and check what they're actually adding. But the point that I really wanted to make here was these are the funds, the 20 most successful funds over the last 20 years. I want you to actually just digest the relative levels of the sales growth, top line growth forecasts from top to bottom. And almost with no exceptions, you are talking about a little bit higher growth than the average portfolio. Again, this is a nudge. If you're trying to build a successful portfolio, you probably want to be in that range, and they do it with quality. The average quality of these top 20 funds is about 86. So, as Ken has been suggesting with some of these uh, screens that we've gone over here over the last few slides, more growth, more quality is a potential path to success. Again, no guarantees in the realm of investing, but this is definitely possibly stacking the odds in your favor. I like to watch the Motley Fool 100 fairly closely for anything that they show interest in, and can have some good fun along those lines. So here's what one of the funds actually looks like, just to give you an idea of what we're tracking, what we're talking about here. This is a very new fund. It's actually an ETF, Bridgeway Blue Chip. And so all of these companies have been added within the last couple of years. Let me double check that. Since right here down the middle, since actually it's a little over a year, since 11/22. So I'm actually watching this as they add more companies. If they add a company to this, I'm probably going to run some analysis on it. And you can see that most of those ticker symbols are very well known to this audience. And if you're a beginner, these are the ones that you want to have on the tip of your tongue. Okay. All right. So I decided just to run a quick screen on those characteristics: quality of 86.1, growth of 13.5. And since great minds think alike, I did the same thing Ken just did, only I chose 250 and got this list. I like this list. There's a couple companies on here I want to study more carefully. Notice that I did not put a return forecast, so some of these down here are in possibly the hold zone, but I do find a great number of companies here. One of these is probably one of my choices for tomorrow night. I do find it interesting that both Eli Lilly and Novo made this list. Might talk more about that tomorrow night also. Anything else here, Ken?
I think this is a very interesting screen, to say the least, Mark. I'm going to be looking very carefully at it because I see a couple of companies that I don't know very much about. I also see a number of companies on this list that we're going to be talking about at length in our stock uh, panel in the evening. So I'm pretty
Okay.
happy about that too.
All right, so we'll close down with just a quick look at, again, I mentioned the Value Line is the other place you can go shopping for companies based on their total return forecasts. And this is something that they've added within the last few years. And I give them a standing ovation. Susie gets all the other standing ovations, but I give Value Line one every once in a while. Here I'm basically going looking for the low total return forecast between 10 and 20. Don't want to go too high, don't want to get too aggressive. Knocks it down to 480. Going for just A plus, A, and A plus plus financial strength knocks it down to 72. We want up straight and parallel. That knocks it down a little bit more. And then we'll also want to look for medium-sized companies. So I started at 7 for the sales growth rate and got down to 17. So again, you're looking at a screening result, which also incorporates a return forecast. I like the Value Line low total return forecast as a guideline. These numbers are attractive to me. So I could very well find a company there. There's a company I mentioned to you earlier, Ken, Sunoco Products. So again, very high financial strength for all of these, decent earnings, predictability, and you can see that their forecasted sales growth rates on the right-hand column. This is a good list. This is a very good company. I just wonder how much Boeing has affected them. And who doesn't like Domino's Pizza?
It's a hot stock in my personal investment club right now because it's just setting the world on fire with its earnings and its stock price. But it's as my wife said, it's not the number one pizza choice in our house. So
Yeah, I do find it interesting that some of these aerospace and defense companies have made this list. And this one is also interesting. I'll probably take a look at that before tomorrow. Recently written up by the Motley Fool.
I I will tell you folks that my favorite stock on the list, and it's not a novice SSG, but my favorite stock on the list is ASML. I really have a lot of respect for that company, what they're doing, how they're doing it,
Yep.
and the fact that they don't have to worry about the chip cycle nearly as much as a chip maker because they don't make the chips. They just do something to all the chips from all of the different companies in the world, and you have to basically go through ASML to have a complicated chip. You have to go through them to make that happen. So gold miners, pickaxes, that kind of stuff.
Mm-hmm.
There they are, ASML.
All right. I see Humana's on this list also, having some of the same challenges that United Health has run into here recently.
Having a lot more than United Health challenges,
Well,
Humana
I was
is.
trying to
Uh,
sugarcoat it, Ken. Don't look at
I
me.
know you
All right.
were.
Also wanted to bring to your attention just because I love the guys at Value Line and the ladies. Um, they do a nice job. They put on a one stock to buy YouTube presentation that you can attend live, and these are the picks that they've made over the last year and a half or so. They're actually doing fairly well. It's also fairly interesting and very telling that some of these big negatives are aligned with the weakest growth forecasts that you see on this page. So combine a low growth forecast with a low quality rating, and you could do some real good Monday morning quarterbacking on how they might raise this number in the future. So again, have some fun with that. All right, so we're going to do some real-time screening tomorrow. Take a look at some stuff. And Ken, would you like to close us down?
We have a stock panel for you. We have Susie Artsberger from Better Investing. She's the IT chief down at headquarters, and she has proved to be one heck of a stock picker. We have Charlene Hansen from the Point of View Investment Club up in beautiful Traverse City. It's one of our model investment clubs, and Charlene presents for us on a fairly regular basis and does a bang up job on picking really, really good stocks. That's my mug next, and I'll be on the panel. Ann Manning from our Houston chapter is the fourth presenter, and Ann has been with us at convention to present, and she's been at a number of our different stock panels. She's on the roundtable. She's one of our roundtable damsels, and she has quite a record in picking stocks that appreciate quite well. That's Mr. Robertson's mug next, and he'll be on the panel. And the
That would be
last
raconteur
person
mode.
on the raconteur mode, okay, and that's Mr. Matt Spielman at the end on there. Matt's a director with the Houston chapter, but he used to live up here in mid-Michigan, and he was a member of one of our model clubs. In fact, he helped start one of our model clubs about 10 or 11 years ago. Before he went off to Ireland and then ended up down in Houston with his lovely wife and son. Matt's a really, really great presenter, and he finds things that nobody else seems to find, and we're always excited when he comes up with a new idea, and he's going to bring at least one new idea to the panel tomorrow, maybe two. So I think you're in for quite a treat if you come to the stock panel. That's the 8 o'clock program tomorrow night. At 6 o'clock, we're going to do some real time, and we're going to do a session essentially which mimics our Two Guys Talk stock sessions at conventions. So we're going to talk about a lot of different things. We're going to do some real time work, and we're going to focus it on novice investors and beginning investors. We're going to try to come up with some contenders for you. You ought to be a contender. So that's what we're going to be looking for. Mark, thank you so much. Thank you folks in the back room for all of your work. We're really appreciative of you coming out and helping us tonight. And we hope we see a lot of you tomorrow. With that, are there any further things that we should be talking about? Anything at all from the back room that we need to know?
Just one item. We're pretty good with questions. One thing is both of you are too modest. Carolyn Sturgis says, Ken, the reason so many seasoned investors attend your classes is because you and Mark are excellent teachers. I always learn something or maybe relearn something. So the kind thoughts from Carolyn. Carolyn, I would say,
Carolyn.
that actually goes for the presenters too. This whole panel is on a day early. To help man the back room, I think also to make sure Mark doesn't get too unfair an advantage, and because we learn stuff too. It's a fun thing to go, and we'll do things certainly much more than we need to.
Matt, thank you so much, and thank you, audience, for being with us, and we hope we'll see most of you tomorrow. Good night, everybody.